Hi, my name is Jeff Belomo, and we would like to personally invite you to the next episode of The Red Wagon, an estate planning and elder law show hosted by me, yours truly, Jeffrey Belomo. On the next episode, we're going to talk about the new numbers for 2023. Now that 23 is upon us, we have to understand what the new numbers are, specifically in regards to what we at Belomo and Associates call tax land, right? For those of you who've seen our workshop, we're going to talk about the new numbers for tax land, annual exclusion gifts, federal exemption amounts. We're also going to talk about the Medicaid numbers. What are the new numbers for Medicaid in regards to if you have a certain amount of income, what assets can you have? We'll talk a little bit about what spouses can keep for their protected share amount, along with other numbers, all things Medicaid. So please join us on the next episode of the Estate Planning and Elder Law Show, hosted by me, yours truly. We look forward to seeing you there. Hi, and welcome. Welcome to the Red Wagon Estate Planning and Elder Law Show, hosted by me, yours truly, Jeffrey Belomo. And on this podcast, we talk all things estate planning and elder law, well, and anything else that we want to talk about. I'm really excited for 2023 as we're going to have a lot of guests this year. We're currently lining up guests for 2023. So if you're interested in being on the Red Wagon Estate Planning and Elder Law Show, please contact the office and we will definitely get a date scheduled for you as we are booking up fast for the Red Wagon and Estate Planning and Elder Law Show. We definitely would love to have you as a guest and spend a little bit of time with you, learning more about you, and everything that we can discuss to have a little bit of fun. Well, on today's episode, since 2023 is now upon us and we're trying to figure out everything as we get into the new year, I thought I would take a little bit of time and talk specifically numbers, right? Numbers in regards to tax planning as well as Medicaid planning. So let's talk about tax planning first. As many of you have heard, whether it be on this podcast or in one of our free estate planning workshops, that we always talk about tax land, long-term care land, and estate planning land. Now, in estate planning land, we're going to always say, I want to control my property while I'm alive and well, and plan for me and my loved one if I become disabled. Control is always the key in estate planning. But we always hop over to tax land, and we do want to talk a little bit about tax land. And just remember, for those of you listening to this podcast, that I urge you to listen to other podcasts in regards to the other lands and how the other lands can affect each other. But on today's podcast, I want to spend time really focusing on the new numbers for 2023. So specifically in tax land, we always focus on the annual exclusion amount. Last year, it was $16,000 a year per person. And now this year in 2023, it is $17,000 a year per person. All right, so what's the significance of that number? Let's say we have a husband and wife, right? The husband can give $17,000 to his son, Jeff. Now, his son, Jeff, happens to be married to his wife, Whitney. So that means that dad could give 17 to Jeff and 17 to Jeff because he's married to Whitney. That's 34. Now, Jeff happens to have a sister named Dina. All right, so what can dad do for Dina? The same thing. And she happens to be married to her wonderful husband, Matt. So again, that's another 34, right? And now what can the mom do? The same thing. 34 is 68. 68 and 68 is like what, 136 I think it is? It's a lot of money. That's the annual exclusion amount. Gift tax free to the giver, gift tax free to the receiver. Okay? Now that's a good bit of money, right? That certainly is substantial. That's certainly a real number. And just to remind you, that is 4 beneficiaries. So I had a husband and wife who had 4 beneficiaries. Now, Jeff, what if they had 4 children who were married? Well, then that would be 8 beneficiaries. So we would have to multiply by 2 the capacity that we just saw. So the breadth of this is huge, right? As far as what can be done and how much you can give away per year. But I want to remind everybody again, a gift is non-take-a-backable. All right? One more time for fun. A gift is non-take-a-backable. So if you give it away, remember, in estate planning land, you can't control it. All right? Now, we're not going to get into the depth of that today. We've done that on other podcasts. We've certainly had a lot of fun with it. But in addition to the annual exclusion gift, which is that $17,000 gift, the dad could give away 12.92 during his life, and the wife could give away 12.92 during her life, okay? Now, they can do that during their life. They can do it all at death. They can do a combination of both. And that is what will enable them to not have to pay, let's say, 40% federal estate tax. 12.92 a person plus the annual exclusion gift per person of $17,000. So, for most of my clients, in fact, all of my clients, we don't have more than $25 million plus $168,000 for the rest of a person's life expectancy. I represent 0 clients. If you want to be my first, please, by all means, give us a call at the office. I'll let my wife know that I'm not going to be home for dinner because I'm planning for your estate, all right? But for the rest of us, that isn't really a number that applies to anyone right now. And just to be in full disclosure, in 2025, it is set to come back to $5 million. So most of us are predicting with inflation, 5.8 to 6 million is probably where it's going to land. But again, that's per person. So that would be, let's just use the round number of 6 million. 6 million and 6 million is 12 million. Anyone under that would still not have an issue from the federal estate tax perspective. For those of us who live in Pennsylvania, please remember that Pennsylvania does have an inheritance tax. Pennsylvania taxes from the first dollar on the transfer of wealth, right? So if you live in the Commonwealth of Pennsylvania at the time of your death and you want to transfer assets to a spouse, still a 0 rate, 4.5% to lineal descendants, children, grandchildren, parents, grandparents, 12% to siblings, 15% to anyone else in the world, including those lovely nieces and nephews, all right? That you really can't get away from, you really can't get around, and as you've heard on other podcasts, I call the inheritance tax a nuisance tax. It's kind of like that pimple on your back that bothers you, goes away, comes back, bothers you. The truth is, I'd rather you keep it, pay the inheritance tax through the estate at the time of your death. That's going to give your loved ones a step up in basis, okay? That means that at the time of your death, if something's worth $200,000, that's the basis that they receive, even if you only pay $20,000 for it. So that will allow them to avoid that capital gains tax. If you try to gift it during life, they're not going to get that step up, and they're going to have to pay capital gains tax if and when they sell an asset. So a lot of times it's actually better to not give it away or to put it into a trust that you control. We're not going to talk about the trust today on this podcast, but we certainly have on others, and certainly you can attend one of our free workshops at Belomo and Associates. For the purpose of today, let's just say tax land is very robust. In 2023, the federal exclusion amount is $17,000 a person, and of course, as we discussed, the federal exemption amount is at 12.92 a person at the moment. So we really don't have to worry much about whether a person can give it away. It's just whether that's the right decision. Remember, the whole point of our 3 lands at Belomo and Associates is a lot like physics, right? For every action, there's an equal and opposite reaction. In estate planning and elder law, for every decision you make in one land, there is an equal and opposite consequence in another land. So just because you can do something in tax land doesn't mean you can do it in estate planning land, and certainly doesn't mean you can do it in long-term care land. So those are really the big numbers that are going to apply from an estate planning and elder law context in regards to taxes. Now I want to hop over to the Medicaid side. And rather than just talk about the numbers that changed, I just want to give an overview and an update in regards to Medicaid. Okay, so Medicaid is a federal program that the states get to interpret. In the state of Pennsylvania, we do have a long-term care handbook, which is really what the caseworkers use as their Bible to tell them kind of what the rules are, the interpretations that the state is taking in regards to certain items. So the updated numbers for Medicaid are going to look a little bit like this. First, let's talk about how much a person can have in assets at the time of their death in order for the state of Pennsylvania not to go after it as far as the state recovery goes. As far as I know, that number has not changed, and that is $2,400. So if a person has more than $2,400 in their name at the time of their death, the state recovery is going to look to be able to recover. As we've talked about on other podcasts, in order to qualify, you have to have either less than $2,400 or less than $8,000. And that depends on the person's income. All right, so if the person's income is greater than $2,742 a month, they can only have $2,400. If the number is less than $2,742 a month of income for the person qualifying, they can have $8,000 in assets. So I don't worry too much about a state recovery in most cases, especially when they work with a law firm who kind of knows this area pretty well, because we generally don't leave more than that in a person's name alone. Just as a reminder, a state recovery is only going to go after assets in the probate estate. Now, what does that mean? That means, what does a person own in their name alone at the time of their death? What does not count? Well, what we would call non-probate assets. What are non-probate assets, Jeff? Anything that's not probate. No, I'm kidding. Non-probate means that it's either jointly owned or has a beneficiary designation on it. So that's your life insurance policies, your annuities, your retirement accounts. A lot of those will have beneficiary designations on them. And on another podcast, we are going to talk about real estate and how to do that with real estate. Suffice it for right now to say that it would be either having it married, owning the property married with a spouse as tenancy by the entireties, or joint tenants with rights of survivorship is the way to do it with a non-married couple. That would avoid probate. There are other reasons with a spouse to take it out of the spouse's name, but not for the purpose of this podcast. On this podcast, we're just focusing on the new numbers for 23. Please check out our other podcasts if you want to learn more about that, or come to one of our free workshops. All right, so we've touched a little bit on a person who's qualifying, in terms of asset levels, 2,400 or 8,000. We generally will always keep a person, even if they're allowed 8,000, under 2,400, simply to avoid that estate recovery portion at their death. All right. Now, the significance of the 2742 also applies when it comes to the program called the Waiver Program. The Waiver Program is a program in Pennsylvania that is still Medicaid, but it is Medicaid in the home. And those hours will be filled by medical agencies locally in the York, Lancaster area, or wherever you are in the state of Pennsylvania. They will be filled by workers from those organizations to come into your home. Now, we do have a little bit of a buffer with waiver. There is an income cap limit, and that income cap limit is $2,742. But there's a $500 buffer per month that if we went up to $500, we could still qualify somebody. So if you add $500 to $2,742, let's call it $3,242, give or take a little bit there. Obviously, when you come into the office, we will run the math and check your numbers specifically. It's called an excess income trust that we're allowed to essentially funnel an extra $500. So for the purpose of this podcast, $2,742 plus $500, as long as we're under that, we could still possibly qualify somebody for waiver. Remember, even if there are some assets and they're married, there's still a way to protect assets and get the spouse qualified and still allow the individual to get the care in the home. So definitely give us a call if that is something that is applicable. All right, so we're at 2742 to determine how much assets a person can have. We're at 2742 for waiver, but we have that $500 excess buffer. So again, you want to be under 3242. And if that's the case, waiver in the home is still very viable. if the assets are greater than the 2,400 or 8,000, it is difficult for a single situation with waiver, but certainly give us a call. Now, when we deal with married couples, there's some important numbers there as well. All right, so we know that the individual, we'll call them the institutionalized spouse, can only have 2,400 or 8,000. Well, what about the community spouse? Okay, so the community spouse is going to be allowed to keep the house, a car, the community spouse's retirement account. One more time, just for fun, the community spouse's retirement account. Did I say the person qualifying for care, the institutionalized spouse? No, I would not, okay? So absolutely, unequivocally, we are talking purely here about the spouse, and the spouse who is receiving the care, their retirement account counts, but the community spouses would not. All right, so for the community spouse, it is, what did we talk about now? We talked about the house, the car, the community spouse's retirement account. We're going to put everything else in a pot, okay? Everything else in the pot is going to just kind of sit there in a pot, and we're going to tell the community spouse, all right, now you can get half of that pot, all right? You can get half of that pot, no less than $29,724, and no more than $148,620. So what if the community spouse has the pot's 20 grand in addition to the other items, the house, the car, and the community spouse retirement account? Then they'll get to keep the 20 grand. But what if the pot is 200? Well, half of 200 is 100. And is that in between 29 and 148? It is. So they'll get to keep that 100. Now, what if the pot is $1 million, right? Well, if it's $1 million, half would be 500. 500 is greater than 148,620. So because we're over 148,620, now that's when we get into other techniques. That's when you come in to talk to us about how we're going to protect 100% for the spouse. Again, not the purpose of today's podcast. We're talking about new numbers for 23, but it can be done. Definitely give us a call if that is something that you're looking at. So the numbers that we're looking at right now for community spouse, the minimum, $29,724, the maximum, $148,620. Again, it's only half of the pot, no less than $29,724, half the pot, no greater than $148,620. If it is greater, give us a call. We are able to protect, but that is not part of the new numbers for this year. Now, that is the asset amounts. Now let's talk about income. All right, so essentially we're going to look at what's the minimum amount of income for the purpose of this podcast. We're not going to really get into the details or the nitty gritty. We have done that in other podcasts. Certainly we do that in our workshops. But for this podcast, I just want to talk about what's the minimum amount of money that I want a community spouse to have in order to live a normal lifestyle or to not become impoverished, right? The Medicaid rules talk about impoverishment, so we don't want anyone to be impoverished. So that number is $2,288.75. So what that means is if the community spouse's income is greater than $2,288.75, the community spouse gets to keep that amount. The institutionalized spouse, the personal needs allowance, I believe, is still at $45. I've not heard that number has changed for this year, for 23. Now, when we're talking about the community spouse, that's where we have to look at, okay, they have it. They're good. They have $2,288.75. We're good to go. Now, what if they don't, right? So if they don't, we are going to allow them to keep a portion of the institutionalized spouse's income in order to be able to get them up to that minimum of $2,288.75. All right, so that's where we're able to kind of divert the income from the institutionalized spouse over to the community spouse in order to allow them to get up to that minimum of $2,288.75. Now, with the institutionalized spouse, we know that they're allowed to keep their personal needs allowance. We can certainly offset some health insurance premiums for the institutionalized spouse. But in regards to, what the community spouse gets, we want to get them up to that minimum. Now, there are ways to get them up to what the maximum is currently of $3,715.50, but that's more advanced for this podcast, so we're going to kind of leave that on the side for now. Okay. In terms of new numbers, those are really kind of the big ones. The minimum excess home equity limit is $688,000. So those are the new numbers for this year in regards to taxed land and Medicaid land. Now, as always, we would love for you to join us on a future episode of the Red Wagon Estate Planning and Elder Law Show, or please check us out. We have weekly workshops. We have them in York and Lancaster. We're offering them in person. We're also offering them with a live stream that you can watch live in the room, but be at the comfort of your home. You can certainly come live to attend, and we always have links that you can watch in the comfort of your home whenever it is convenient for you. So whatever works best for you and your schedule, we would love to have you at Belomo and Associates for one of our workshops. We do have pre-planning workshops, crisis planning workshops for individuals or loved ones who may need a nursing home within the next year. That process is very favorable in terms of the results, but it is a lot of work. So you want to kind of know what you're heading into ahead of time so that you're not blindsided. We do offer those workshops on a regular basis, and we have links to those. We do have special needs planning workshops that we offer in the community, and we also have a link to be able to watch, as well as probate and trust administration when we lose a loved one. So, I hope you enjoyed this episode of the Red Wagon Estate Planning and Elder Law Show, hosted by me, yours truly, Jeffrey Belomo. Please, feel free to reach out to us at Belomo and Associates to let us know what you would like for an upcoming version of the podcast. Certainly willing to talk about anything that would be of interest. And if you would like to be a guest on our podcast, we would love to have you. If you're trying to reach us at our office, it's 717-845-5390, 717-845-5390, or check us out on the web at www.belomoassociates.com. Can't thank you enough for joining us on this episode of the Red Wagon and Estate Planning and Elder Law Show, and we sure hope to see you on the next episode of the podcast. Thanks for joining. We hope you have a wonderful, wonderful day.